Investing in Web3, Unveiling VC's Analyst Frameworks.
A pleasure to be here. My name is José Pereira. I'm from Caerus, and our mission is to create more of what matters most, and that's culture. We are a near protocol ecosystem fund that invests in early stage startups that will enable the digitalization of culture and entertainment, i.e. sports, music, arts, gaming, TV, and film. And today I'm going to be speaking about the processes that we go through to assess investment opportunities. And at the end of the presentation, you will find a QR code that will give you access to all of our frameworks, diligence processes, so you can use them if you are an investor, a founder, or a retail investor as well. So, origin, it's a bit of a dramatic title for this slide. I got into Web3 purely because of speculation. I had a friend I had not seen in a while. He had made money in the previous bull run. So I bought Bitcoin, bought Ethereum, price went up. I was immediately hooked. Started learning about the technology at a more deeper level, the layer ones, the tokens. And when I got to the ethos part, the bigger picture of crypto and decentralization, trustless exchange of value, that's when I really fell in love with the industry. Went all in professionally, and through my time in the market, I did 2 round trips, meaning this is the portfolio, this is time making money and giving it all back to the market. Did that twice. Point is that I took all of those learnings and crystallized them into a framework that I've been developing for the last 3 years to keep myself from making those mistakes again. Sometimes stupid, greedy decisions can burn your portfolio. So yeah. This is something, it's a self-learning model. The things that I learn new, we adjust them. So something, again, that I've been working for the last 3 years. Just a quick statistic, 42%, the risk of failure of Web3 startups is 42% greater than and twice as faster than your traditional technology startups. Web3 startups, 40% of them fail within the first year. So the point is Web3, investing in Web3 is riskier than your traditional software as a service. Again, the same point, Web3 is imperfect. It's a nascent industry. There's still things that we are figuring out. There are siloed applications. We haven't found a killer use case for the masses yet. There is a regulatory framework that we are also developing. So it just highlights how we are still early, and we are on time to catch the next wave of investments. So a point that I wanted to make is that as you've seen the adoption of previous technologies, for example, Facebook, it took 4 years for them to get to 100 million users. Instagram took them 2.5 years. TikTok was 9 months. ChatGPT was two months. So the rate of adoption is gradual until it's sudden. So that's where we want to position ourselves from an investment perspective. 75% of venture-backed businesses fail. Failing meaning they go to absolute zero. They never return capital to investors. The rest of the 25%, you have mediocre performers mostly, which are the companies that return 1x, 2x, 3x. And then you're going to find a very small number of companies that become successful. And successful meaning beyond your dream successful, billion-dollar companies, multi-billion, trillion-dollar companies, like the technology that we use nowadays. Those are called unicorns. And of course, finding those is very difficult. So the point is, Web3 is riskier than your traditional technology startups, and venture capital is already difficult. So what can we do to increase our hit rate, which is the companies that are successful? If you see here, early stage companies look very similar. There's no clear indicators of success at this point. So the only thing that we can do is identify the points of failure, the risks, the red flags. So I'm going to walk you through our framework. Starts with a qualitative filtering. You have 2 sides. You have the internal filter, which depends on your team's strengths, your team's ability to foresee success, to identify a good from a bad business model, and their ability to help these startups succeed. So you start by making a market segmentation activity, and you fine-grain it to, again, your team's strengths. In our case, it is culture and entertainment, so we do not look at the things where we do not have expertise. We focus on the ones where we feel that we have a unfair advantage. And as an investor, that allows you to go from reactive sourcing, which means you receive the deal flow and then you just filter out, versus a proactive approach, which means you know exactly what you're looking for, so you go and find it. The next part of the qualitative filtering is the external, which relates to the companies that we're looking at. We have 3 pillars. The third one is specific to us because we're an ecosystem fund. But you have the team, has to be a compelling team. The market opportunity, if the market opportunity is not large enough, if it doesn't have scale, it doesn't make much sense for us to dedicate more time into it. And the third one is the strategic fit. Again, for us, for Near Protocol, there has to be a benefit as a blockchain that brings traction, credibility, brands, enterprise clients to it. So now we've filtered in to what we're looking for, and then we start filtering out the companies, and you're left with a smaller group where patterns start to emerge. So you will see that after you see many deals, exceptional founders stand out. Also, the way that they approach the problem, features in the product also make for a unique and special investment opportunity. Once we like it, we go to the next step, which is the analysis of risk. And you will see that this is not a binary decision, 0 or 1 thing, but we try to gauge the risk of each of these things. So for example, the first one says treasury. How does the startup manage their funds? There was one that I was very excited about to invest, and they had around $1.5 million, gave them 12 months of runway. The thing is that they were putting 1 million of that in USDC, earning yield in a CeFi platform last year that went through the liquidity crunch. Same thing when all of the UST crash happened. They lost that money. The runway was cut to 3 months, and it led to the startup failing. So next is the use of funds. You have growth catalyst, which is the ideal scenario that you want to see. You want to see a company that has their numbers in green, that is going to use the funds to go to that next stage of growth. You can also find, I put their lifeboat, you're going to find some companies that might be in a tough spot and they need to raise money to go through the next 3-6 months to then raise a bigger round. It doesn't mean that they're going to fail. Maybe they go through it and then they become ultra successful. But the point of this is riskier than the alternative. So just to get to this quickly. Next, I think that the best example here is when we look at founders. Again, we cannot discard a founder for some of these reasons. You're going to have first-time founders, young founders that, there's the star cases, the Mark Zuckerberg, the Vitalik Buterin's, that would be a riskier investment when you compare them with repeat founders that have 20 years of experience. But again, you'd be surprised with who you invest in. I'm getting late on time, sorry. So next, we have the scoring model, which is taking all of these guidelines and assigning a score to each of these. And one example here is looking at the launch strategy of the token. So when the token is launching, are they going to a DEX? Are they going to a centralized exchange? Which exchange are they going? Are they using a launchpad? So for us, the lowest risk option is going to a reputable centralized exchange, the Binance, the 𝐒𝐭𝐨𝐲, the KuCoin, but of course that's a more difficult and expensive deal. That's an ideal case. And then you go down to a project that is launching into an unknown launchpad. Might be good. You never know. The thing is, the risk is a lot higher. So that's how we assign scores to all of these. And yes, this comes from a subjective scoring. But once you use the same scoring model across all of the companies, then you will have consistent scores. The next step is diligence, which is making sure that the information stacks up. So whatever they say they have in runway, their finances, their projections, we look at all of these, make sure that it's true, that the projections make sense, that they're data-driven. We look at the source code, security audits, if they have any legal cases that can present, of course, big risks. And the takeaway of the presentation is that Web3 venture capital in 2021-22 was very much driven by gut trust. And the point is that it's an important thing to have that human factor and foresee these opportunities. But the better alternative is to have a methodological process, starts from filtering, analysis, diligence checklist, plus that human factor that is going to keep you from falling in love with a company, with a founder, with a vision, and be more objective. So, This is the QR code that I was mentioning, so you can find there all of our templates, scoring models, my contact information, and any information that you need after this. I'll be more than happy to help you with. So thank you so much for your time and attention. Pleasure.